If your goal is to acquire an investment property at some point this year or next, and you're trying to decide whether or not you go the USDA route or the DSCR route when it comes to a loan, well, buckle up because it's going to be a bumpy ride. Let's dive right in. We're talking about acquiring a business property or an investment property from a real estate standpoint. Right off the bat, let's cut right to the chase. A USDA loan is not going to be an option. A USDA loan, which is extremely favorable for those individuals who are taking the route in order to qualify for a mortgage, has one quite sticky requirement. And that requirement is it must be your primary residence. When individuals are trying to utilize the USDA program in order to get access to a loan for a single family property, unfortunately, that's just not going to be an option for you if your goal is to actually acquire a piece of investment real estate. There is a USDA program that does allow for investment in multifamily, but you have to do so during specific investment windows. And currently that window is closed. But you can jump into the USDA website and Google the loan programs that are available, and they'll spell it out all for you. But again, the benefit of the existing USDA program is that it gives you amazing access to lending for very specific types of properties that are situated in much more rural areas, properties that are situated for individual family use. And if you do acquire a loan, such as a USDA loan, you know that you're going to get reasonable terms. Now, here's the challenge though. If your goal is, again, to be an investor in real estate, a great option is the alternative, the DSCR. The DSCR stands for Debt Service Coverage Ratio. It is a particular type of loan that's specifically designed for investors. What I'd like to do is I just want to break down what the DSCR is so that you have a better perspective and can make an informed decision on your next investment property. First and foremost, I want you to understand that this particular type of loan is not available at every single lending institution. In fact, there are only a few lending institutions that offer it, but if you can get access to a DSCR loan, it could get you access to investment property that you otherwise wouldn't be able to touch. Let's talk about how it works. The lender in a DSCR is not necessarily concerned with you as an individual from an investment standpoint. They're mostly concerned about the underlying property you're going to be acquiring. That's why it's referred to as a debt service coverage ratio loan. What does that mean? Well, it basically means they're going to take the net operating income of that particular property, and then they're going to divide it by the cost of capital. What does it cost you in order to access that capital? Principal payments and interest payments on the mortgage. So your net operating income divided by principal and interest, that's going to give you a ratio. For instance, let's assume for the moment that you had a net operating income on a property of $10,000 per month. If your cost of capital was $5,000, your debt service coverage ratio would equal 2. $10,000 divided by $5,000 equals 2. The debt service coverage ratio that most lenders are going to say is the absolute floor for them to even consider issuing a loan is 1.25. So if your debt service coverage ratio is 1.25 or greater, it is likely that that financial institution will believe and understand that this particular property will perform to a degree to satisfy the debt burden that's outstanding on any capital that that particular lender would be issuing you in order to acquire the property. There are some other things to be considered here. They don't necessarily ignore you entirely. What do I mean by that? Well, they want to make sure that you are a legitimate borrower and a reasonable risk from that borrowing standpoint. So they're going to take a look at your personal credit, and your personal credit score needs to be at least 620 or higher. So if you have a 620 credit score or higher and your debt service coverage ratio on your acquired property, the property that you're targeting for acquisition, is 1.25 or greater, it is highly probable that you will be qualified in order to get that particular lending. Now, what do you do with that lending? The lending for a DSCR is available for investment properties. Those investment properties can range anywhere from 1 unit to 8 units. It's important to know that each individual lender will have its own standards. So one lender, lender A, may say,
we're not going to loan on a DSCR for anything greater than 4 units.
And another lender will say, okay, we'll go all the way up to 8 units. So you will have to shop around a bit to find the right lender to fit your particular needs. Once you find the individual that is willing to fund that particular acquisition, it can put you into the driver's seat for leading you to the financial future that you'd actually desire. Before I let you go though, I do need to let you in on some of the drawbacks of utilizing a DSCR loan. Drawback number one is DSCR loans are issued by private lenders. Oftentimes those loans come attached with higher interest rates. You may be able to qualify on a conventional loan, for instance, at a much more favorable interest rate, but those qualifications are going to take into account your own personal financials, meaning they're going to want to look at your tax returns, get verification of your income, take a look at your credit score, etc., and making sure that even your personal debt is in an environment that does not preclude you from accessing those traditional loans, like conventional loans, for instance. A DSCR, on the other hand, doesn't look at any of that information. They are looking at your credit to make sure you're credit worthy, but they're really primarily concerned with the underlying performance of that property in order to qualify for the lending. But drawback number two has to do with the underlying performance of that property. If you are in a situation where that property does not perform, well, then that can put you into a pretty precarious situation, because if you cannot justify or do not have the free capital to support the loan on your own outside of the property's performance, and if that property goes without a tenant for a particular period of time, that can actually adversely impact you in your financial life and potentially put that property at risk from a foreclosure standpoint. So you want to make sure you're diving in, really understanding not just that particular property, but the entire region. How is the region performing with regard to tenants? Is it an environment where there are a lot of tenants who are interested in properties like yours and maybe there's a waiting list, or is that in an environment that, quite frankly, if it does go vacant, that vacancy period could extend for a long period of time? Another drawback that you have to consider is the fact that the DSCR loan is issued by private lenders, which means it's not readily available at every single financial institution that's out there. So it could be quite laborious for you to track down a lender that is willing to engage in the DSCR for you. All of that being said, if you have an opportunity to take advantage of the DSCR, it could be just the right thing to help move the needle in your journey of financial success. I hope that you found this valuable, and if you have, be sure to hit that like button and subscribe so that you don't miss content just like this going forward. I wish you well in your journey. Bye for now.